Hey everyone, Patrick Jackson with Mann Mortgage here with this week's market update. Today is Thursday, August 18th, and it's about noon on the West Coast. Over the last couple of weeks, the market has been on a little bit of a roller coaster. The last week specifically has been a little bit of a downtrend for mortgage rates. I believe when I did my video last Thursday, the average conventional rate for a 30-year mortgage, according to a national survey of lenders, was at about 5.25%. And this morning we're about 5.5%. It's gone up about a quarter of a point based on different national surveys and numbers and a bunch of technical things. But we're definitely still on a downward trend from our high points in mid-June. So first thing I wanted to cover with you guys, let me go in here real quick. I wanted the July. So CoreLogic came out with their existing home sales for the month of July. Keep in mind that these are national numbers, so not hyper-specific to a certain local area, but national. And also keep in mind that if these are closings in July, so these would be home buyers that were going through the mortgage process in either May or June. So really at the height of mortgage rates. So it's a pretty good snapshot to look at because it basically would be looking at people buying when it was kind of the worst time to buy, in the recent times. So going over this real quick, it looks like we're down about 20% year over year as far as the sales. The home price is up about almost 11% year over year. So the national average now is up to about 404K. First time home buyers are down slightly from 30% last year to 29% this year, and 30% last month, 29% this month. And so that's actually lower than we'd like it to be, but considering it's not really the best time to be a first time home buyer. Given they often don't have the income that more mature buyers have and don't have the assets, from a prior sale and so forth. 30% is still, 29% is still a solid number. Cash buyers are down from last month. As a loan person, I'm fine with that continuing to drop. Investors are down from 16% last month to 14%. And that's something we need to keep an eye on as economy shifts, as possible things happen on those fronts. Maybe we see less investors splashing around and buying houses in the markets, which obviously you lose investor clients in doing that kind of thing. But also, that opens up a house for maybe a first-time home buyer or a family to buy that maybe they would have been, not able to compete with last year when rates were lower and more investors were looking. So, in a lot of ways, it's a healthy thing for the housing industry. If normal folk can buy some of these houses and not just be swooped up by LLCs and investors and corporations. And then looking at inventory, they're up slightly last month, 1.31 compared to 1.26 million. And that happens every year at this time. We've talked about that before. It's listing season. It's the summer. Generally, we see that kind of tap out. Maybe August will get a little higher than come down. Maybe July is the highest number we see because as you get closer to the fall, people have either sold those homes or they take them out the market. Not as many people are listing late in the summer, and so forth. So that gives us about a 3.3 month supply, where we consider 6 months a normal supply, a normal market. So there's 747 active listings, 43% are under contract. So that means that out of all those homes available, 43% have actually already had an accepted offer. And as we all know, most of those houses will close. They'll either close with the current offer or they'll have a backup offer. So really, we can look at that supply as an actual lower number than they're actually showing. So if we take those out, we're actually under 2 months supply. And that 43% number, 25% is normal as far as, listings under contract already for these kind of reports. So 43%, that number kind of shows that the markets are still active. People are still buying homes and so forth. I know I saw a Redfin data that came out. Multiple offers are about, nationwide are about 3.5 per home. So there's still multiple offers. It's not just down to 1 or 2. So still, that kind of shows that, and then we have the 14 days on market, which is a record low. So, there's a difference between a recession in activity, meaning we see less activity. I know new home builders are concerned. There's less permit starts and stuff like that, and a recession in pricing. And with activity down, with less houses being built, that actually will help with the pricing, or it's going to keep prices for current homeowners kind of where they're at, and not having a depreciation, since we'll continue to be dealing with supply issues, it seems like. So that I wanted to move from there. And another data I want to share with you guys this week is this came out from, again, a CoreLogic number. It has to do with single family rent index year over year. So this is a topic I've talked about quite a bit on these videos, is that, renting kind of sucks. It's not, obviously rates are higher than they were last year, albeit we're at historical lows still. Mid fives is really not that bad when you look at historical rates. But renting's even worse. Rent continues to go up. You can see going back to 2005, where we kind of dipped in the late, right around the housing, crash area, and then kind of stayed pretty even up until the pandemic, and then it's just taken off since the pandemic. I believe, their stats show it's about 13.2% year over year is the increase in rent. So not only is the rent gotten more expensive, but like we've talked about, you have zero control over your housing stability. Your landlord's in control. You don't know, are they going to sell this next year? Do I get to continue to live here? Do my kids continue to go to this school, and so forth? So that's one aspect of it. And even if you are already a homeowner and you find a house you love, and you can afford the payments and it makes financial sense, that's a reason to pull the trigger too. If you want to live near your children and you want to move, if you want to live on a golf course because that's your lifestyle, you want to play golf all the time, that's a reason to move. So we should stop looking at things as so much from the investment standpoint and more in the lifestyle and in the financial, does it make sense for my family standpoint? And most of us still buy homes to house ourselves and our families. So if it makes sense, like I said, if you can afford the payment, it makes financial sense to pull the trigger, you definitely should do it, and not just kind of wait and see what happens, because that house, that dream home that you really wanted, or that starter home that you wanted to move your family and get out from your landlord, there's a good chance that house is not going to be available for very long, given how how active the market has been. So, like I said, it's definitely not a time to stay on the sidelines when your life can improve, whatever decision you might end up making. Like I said, getting away from that landlord, getting closer to family, getting into a situation that you've always wanted to be in next to a lake, you go boating, whatever it may be. So again, that's the most important part, is being happy and whatever makes the best for you and your family, not from looking at it straightly from a numbers investment standpoint. So that's all I had for you guys. Let me get out of here real quick. That's all I had for you guys this week. So if anybody ever needs anything at all, please do not hesitate to reach out, and I'd be more than happy to help. Hope you guys have a great week, and I'll see you guys again next week. Thanks a lot.